Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Our last panel of the day is a sellers panel. Insider tips from CEOs who've built and sold their own AI companies. This is led by Manuel San Miguel, Senior Vice President at Quorum Group. Manuel, all yours.
Welcome everyone to our sellers panel today. My name is Manuel San Miguel. I'm a senior deal maker with Quorum based out of Madrid. And I'm joined today with a fantastic group of entrepreneurs who have gone through this journey, some of them multiple times, of building companies and working toward an exit. So I'm really looking forward to the conversation we're going to have today. So first of all, let's lead in with some brief introductions. Let me start with Sue, please. If you could give us just a real quick intro of yourself and the company you just exited, please.
Oh, hi. My name is Dr. Sue Abu-Hakima. No, I'm not an MD. I have a master's PhD in AI. I've done 3 startups in AI now. 2 of them exited successfully. Latest one was in emergency communications and AI, and we exited in during the pandemic. So had great customers there, including the NFL and others, but I'll talk about that during the session.
Wonderful. Well, thank you very much. Giacomo, please.
Hello, everyone. Thanks for having me here. I also have a PhD in engineering, and I'm the founder of Intello, an AI solutions company, which made an exit in June this year. Happy to tell you more during the panel session.
Wonderful. Scott, perhaps.
Hi, Scott Petersen. I was a co-founder of HIRECLICK, which was a hiring system or applicant tracking system really targeted at small businesses in the US. We had an exit event in July of 2024 and were acquired by Assure Software.
Wonderful. And Dr. Frenkel, please.
Hello, everybody. Thank you for having me here. I'm a board-certified infectious disease specialist physician, as well as an epidemiologist. I've had experience in private practice, having built my own practice, as well as a medical director of infectious disease and community and large corporate settings. I also have experience in long-term care and rehab facilities. After working in rural America and seeing the gap in antimicrobial stewardship or their lack of expertise in infectious disease to guide clinicians appropriately when it comes to antibiotic usage, I focused my career on democratizing infectious disease and globalizing antimicrobial stewardship so it's accessible and affordable despite limited facility resources. And I started this process manually, but eventually co-founded Arkstone, a biotechnology company that uses AI and machine learning to implement clinical guidance to clinicians the moment they get their infectious disease results from hospitals or laboratories. I also focus heavily in clinical informatics and clinical research in this realm, as well as bringing real-world data and successful outcomes using machine learning and AI to the scientific community.
Wonderful. Thank you very much. It's really interesting that we actually have 3 doctors on the panel. Only one of them is a medical doctor, and everyone here obviously has a very strong link to machine learning and AI in both their backgrounds and the businesses that you've built. So I think this makes for a really interesting context for our conversation. I'd love to hear a little bit more about, I guess, what motivated everyone to look for a sale of your companies, and kind of what was that fit that eventually attracted to the eventual buyer? So maybe if we want to start with Giacomo, kind of what, maybe a little bit more about the nature of your business and what really drew you to try and find a partner.
Yeah, so thank you for asking. In our situation, Intello has a quite diverse offering of solutions that plug into horizontal platforms like CRM platforms, workforce management, just to name a few. And we've been growing quite steadily. The company has celebrated its 10th anniversary this year, reached 100 people, and a considerable size of business for being a European Italian company. However, we reached the point where we needed a dipping. So we had VC funds in the shareholding structure. They were starting to seek for an exit, but honestly, that was not the real driver of that. The real driver for us as a founding team, as a founders team, was okay. How do we fuel the growth for the next stage of the company, right? As we were entering the growth stage, leaving the startup stage, what is the best path? And actually, we did evaluate a few options, and we were about to embark onto an IPO road, potentially on the Euronext growth market, for small and mid cap companies. But we encountered an industrial partner along the way, which we believe was a very strong fit. Its name is Assist Digital. It's a European-based group, founded in Italy, but with a pan-EU footprint. And we thought that would have been the best fit for us, really, to keep growing in the next few years. So that's what brought us there.
No, wonderful. And I guess Ari, from your side, kind of tell us a little bit about Arkstone and what kind of motivated you to come and go down this path.
It was really quite simple. We obviously gave us a lot of thought, but given the growth and trajectory of Arkstone, we needed a partnership that could accelerate our growth beyond what we could already do with the resources we had at the time. So simply, we needed expertise, we needed guidance, we needed structure, we needed all of that. And we thought the best way to achieve that is seeking a good partnership with a like-minded company.
Okay, excellent. And I guess, that idea of seeking the right partner for backing to try and arrive at scale is one of the key drivers. And I know, Giacomo, you mentioned that sometimes a driver that has to do with folks that are already on your cap table. You sometimes have investors that are trying to drive some growth, but sometimes we have occasions where you don't necessarily have those investors, and still there's a clear motivation for finding a partner. And I know, Dr. Su, before we started the panel, you mentioned a little bit about that. I'd love to hear a little bit about that part of your story.
So we've gone through 2 exits, and as I mentioned, I believe so we were not venture backed for either company. The first one, Amica now, was doing automatic content analysis to mobile phones. When the markets crashed in 2001, we converted that to compliance. So it was email content analysis to meet GLBA, SOX, HIPAA, privacy, so compliance laws. And we would process millions of messages a day. So Entrust came calling. We went to do an OEM with them, and they decided instead of an OEM, they'd rather buy that whole compliance capability, because their customers who are banks and government, et cetera, were asking them to look inside the email before they encrypt it. So that's the first exit. The second one was an emergency communication. It was weird because we'd already being approached by at least, I think we had 5 or 6 potential M&As going on. We hadn't gone out and actively sought an M&A. We had been talking to Quorum, so we knew what our valuation was. And I just got a call out of the blue in January 2020, which was pandemic time, saying, how would you like to be bought? Now, looking at it 5 years later, they obviously bought us for our customers, because we had, people from the NFL, the VA, Canadian, RCMP, police forces, et cetera. And we were doing emergency communications. So if you were in a stadium, airport, there was an active shooter, we could lead people out to safety using maps and things like that. And it was all based on agents, or in today's language, agentic AI, if you will. And so that's how that exit happened. And because we didn't have venture capital, we had a board of directors and a board of advisors, which I think everybody should have as soon as you start off your business. And you sort of go back and forth with them about whatever it is that's hit your plate. And I got one of those calls saying, how would you like to be acquired? And then at first I said no. And I went and I talked to my co-founder, CTO, and he said, why not? And trust me, guys, this was in January 2020. So it was before everything crashed. They came up from the US and looked at the company because we were based in Canada. And they just made it before the shutdown. The shutdown was in March, I don't know, 15th or whatever it was. And so they looked at the company. And then after that, we negotiated it all remotely. So it was a crazy time. And this third company, Alstari, which is also has, it's focused on AI and security. I'm not in the process of trying to sell, and I have been offered money, but I haven't taken them.
Yeah, I think arriving at the right timing and understanding that inflection point is really important. And I think being able to talk with folks who understand the trends in the market, understand kind of where you fit in that flow, I think can be actually quite valuable in helping arrive at that decision. Scott, I'd love to hear about HIRECLICK and kind of what drove you guys to come out to market.
Yeah, so HireClick, as I mentioned, hiring system or applicant tracking system targeted at small businesses. Is founded technically late 2017, early 2018. And really what drove us to kind of going the route we did is probably market conditions and also needs of our customers. Our company is, very small in terms of people, 11 people, very, very closely held. No board of directors, really just managed by myself and my co-founder. And what we saw, we were able to grow pretty rapidly. And you hit that I don't want to say wall, but you hit that realization that the changing need of our customers. We did only recruitment, and we kept on hearing that the needs of our customers was really to have a full solution in the HR stack. So they want recruitment, they want onboarding, they want payroll, they want benefits, et cetera. And as much as we tried to whiteboard that and figure out if we could get there, it was a choice. We either had to raise a lot, which I felt like we probably could have, but I also felt that we had a short window to get to where we needed to go. That same year, ironically, we started getting a lot of inbound activity. There was quite a bit of roll up in that space, and just led us to really doing our due diligence on who we wanted to partner with going through it, and found out that it was a good time to hit the market when we did. And that kind of led to what occurred last July.
Wonderful. And I mean, it's always kind of interesting to understand, again, not only the decision going into market, but also from the buyer's perspective, what are they looking for and what kind of drives their attention? I mean, you mentioned roll-ups. Dr. Su, you mentioned that it was clear that for the lat exit, people wanted their clients. I guess, Dr. Frenkel, from your side, what do you think attracted the eventual buyer, and what's really made you stand out in their eyes to want to try and kind of close the deal?
We met with several investors and possible partners, but the buyer that I think really stood out was one that had a focus in the health tech sector, which was really specific to us. So it really spoke to us that this is their focus. This is what they do best. They've had a successful track record. So from our standpoint, that was really what attracted us. But more importantly, I would say I really did feel a connection with the other team. And to me, that's the most important element of when it comes to working together and having a successful outcome, because we do want it to be successful post-transaction too. We want to take this company to the next level. So I felt that there was a connection. I think they felt the same thing as well. And we noticed that our goals aligned with what we wanted to accomplish post-transaction. So I think that those elements lined up, and I think what attracted us about the buyer is the same thing that attracted the buyer to us. They saw that we're in the perfect market. We're ambitious entrepreneurs, and we happen to be in the space that they were looking to invest in at the time. So that, I think, just made it work.
Wonderful. And Giacomo, what about you? What do you think about your business was that attracted the eventual buyer, made them pay attention and engage with you guys?
I think in our case, it was our competencies and our offering. So our offering is very much focused on the value chain of the data and the AI spectrum. And the buyer was seeking to enhance their offering with this kind of services and solutions. The positioning of a solutions company, so blending professional services and proprietary software, was also attractive. The fact that we were profitable and we had, big logo clients was important. And also the potential synergies that they and also we are seeing are achievable in the deal, because we share the ambition, we share the entrepreneurial spirit, And we actually have a lot to offer to their existing customer base of the industry partner that has acquired us. So I think it's been a real win-win. What motivated us, as I said before, is a little bit the fact that we could see that this could represent a very important opportunity for us to boost the growth. And also, as Dr. Frenkel said, the people that we saw on the other side. We had a long negotiation, but the deal was made around a table where we could really appreciate the human factor of the team on the other side and the entrepreneurial expertise. So we could see we were aligned in terms of values and ambitions. So that was also what drove us towards the deal.
Yeah, I mean, I think it's both of you have mentioned that idea of fit. And often when we work with clients going into the process, people start predictably thinking much more in financial terms. And then during the process, it becomes a lot more about fit and how that whole thing works and how you're going to work post-transaction, post the deal, not only for yourselves and even if you're exiting the organization, but for the team that remains, which is really interesting because it can be quite a long process. So there's a lot of interaction between buyers and sellers. I mean, from a timing perspective, I guess, Dr. Su, in your case is interesting because you're leading right into the pandemic. What was the timing like for that process, kind of start to finish for you?
It's funny because since we went through 2 acquisitions, right? We knew we had a sense for, and they were both with publicly traded companies. The first one was to Entrust, the second one was to Genesis Inc. So we knew there was going to be a lot of diligence, a lot of lawyers, and a lot of time spent on it, to the point that the first exit, Entrust hired an accounting firm to come in and get a valuation. And even then they didn't respect their I found out later, their numbers. In the second one, I would have to say we negotiated for 10 months. In the first one, we negotiated for probably 3 or 4 months because we had started the deal, didn't like the number, cut the relationship, stopped talking to them. And then they came back in a few months later with KPMG, and then the deal happened within, I think, a month after KPMG was finished. But that whole process took about 5 months. So the first one was 5 months, second one was 10 months. During pandemic, it was insane. And I think what was interesting about the pandemic is that we just sort of kept our heads down. What helped us is that we could keep our team at home. So nobody was really trying to figure out what the heck are these people doing? What are all these meetings and who are they talking to and why the board of directors again? In the first one, what we said was that the board has asked for evaluation. And so that's why they brought in this external firm to evaluate. Second one, we used the same excuse. We said the board has asked for evaluation. So we're doing a lot of heads down stuff. And I have to say the only nutty thing that happened is that the acquirer started using our address in Canada to get mail from I'm not even going to mention the department. And so some of my team were in it and saying, what the heck, what's this letter addressed to this company coming to us for? They're not even based in Canada, they're based in the US. And I said, oh, well, we're doing a partnership with them. Don't worry about it. And so that was a little bit loopy. But anyways, so that would be negotiating during the pandemic was intense. But, the one thing I have to say here to all my CEO fellows and yourselves at Quorum, one of the most important things, the lessons that I learned in the second exit, because I knew the first one was not as high as it should have been. And today I'm sure it'd be $1 billion or something ridiculous. But anyways, because it was an AI company, you have to get a number in the second exit. I had to get to a number that I could live with and my team could live with and my investors and my board, et cetera. Even though I didn't have venture cap, I wanted a number that I could live with. And I'm happy to say that I got it. And I'm sure you're going to ask us about the structure of the deal later. I'll talk about that. And by the way, not to advertise for myself, but I did write a lessons learned book. I spent 2 years while I was in golden handcuffs and working for the acquirer, writing a book, which is very nice. It doesn't say anything bad, but it's got really good lessons in it.
Oh, wonderful. Look forward to having a look through that. And I guess, Scott, from a HireClick perspective, what was that process like for you? How long did it take, and what was the timelines around it, broadly?
Oh, you're muted.
Oh, we've lost your audio, Scott.
Oh, he's muted.
I'm not sure. Can you hear me now?
There you are. Yes.
Okay. It was fast and furious. As I mentioned, we were getting some inbound activity. We were talking to some pretty large private equity companies, which prior to the actual event, that really got us far down that chute, and we felt pretty prepared when we started the process with the company that eventually acquired us. Our LOI to closed deal was 33 days. It was really fast. Assure Software is also a publicly traded company. They were motivated, we were motivated, but that 33 days was extremely intense. To be specific, 392 hours of mine in that 33 days. But we always felt like the mantra of our company being small, small but mighty, we would always say. Our mantra as a company was we're not going to get outworked. And when you get into that diligence process, we felt the same way, and we're able to get through it. There definitely some challenges. Imagine being in a really small office and taking, private calls and things like that. So there was that was a change for us, in and out of the office quite a bit, taking lots of phone calls that we just couldn't do with very thin walls in the office. But I always, my bit of advice in going into it, for anybody is get that dream team assembled, so that you can act quickly and that you can respond very, very quickly. And we found that having that team in place and communicating just how important this was that we get it done quickly ahead of time was really, really important, so the schedules can get cleared and so forth, and worked out very, very well.
Oh, that's wonderful. 33 days is amazingly fast. For us, it's quite common for due diligence, depending on how complex and how many external parties get involved. It can last easily 60, 90 days, and sometimes upwards of that. In fact, for Arkstone, I guess, Dr. Frenkel, from the process perspective, your timeline, but what did you find was maybe the hardest part of that process, and kind of how long did it take for Arkstone to get through that?
Yeah, from my recollection, I think from start to finish, from engaging with possible partners and investors to the very end, maybe 6 months to 7 months. And I thought that was pretty quick, actually, because we had some members of our team who've done acquisitions before, and it took over a year. So I didn't know that we had the option, Scott, to go much shorter than that. But I think the most difficult part for us, and we were a small team as well, was the paperwork and those kind of processes involved. As you can imagine, there's a magnitude of information that both parties need to make the deal right and work. So that retrospectively, now moving forward, have everything in order as if these opportunities will be there. Just imagine these opportunities will be there and set yourself up so that these things are just a click away. Looking for documents that are 7 years old, not efficient. So I think that was the hardest part of all of it. There was an emotional aspect, I think, as you, Emmanuel, had warned us about, which I thought I had thick skin. I said, I can easily handle this. But it gets to you, the emotion of partnering, selling part of your company. That was also something that was difficult, of course, to internalize the unknown of what your future may be like. But thankfully, it worked out very well in that respect as well.
Excellent. I mean, you just touched on something that's quite interesting. One, of course, preparation generally, and we talk to thousands of companies, and many of them are in a stage where they say, well, I'm not really thinking about a process yet. I want to hit certain milestones. I want to achieve certain things before I get to that stage. And a lot of the conversations we have is great. Start preparing now. You'll be happier later if you now get everything structured, cleaned up, ready, so that when you do have that opportunity, it doesn't really distract you from your day to day. and let you get the process a lot smoothly. I guess, Giacomo, from your perspective, was there anything, I guess, during due diligence that surprised you, that you felt maybe unprepared for, or that you would advise someone to kind of keep an eye out for?
So for us, this was the second due diligence we were into, because the first one was with the VC funds 3 years before. And I have to say, whereas the first one was 2 to 3 months in length, it wasn't too bad. This one took about 6 months from LOI to the closing, and it was much more intense and deep. You know, the level of detail we had to provide. I mean, it was a private equity type of, M&A operation, so it was really, really much into the details of everything. And I have to say, the piece of advice I would like to give is, surround yourself. Either you have an internal team that can prepare for the process, but you need to have people that have gone through the path before, because you can't. It's very difficult to learn if you've never done it before by yourself. In our case, even though we had done it once, and we knew it was going to be hard, and we didn't frankly have time to prepare, we had to rely on external advisors. So for us, the choice of legal and an investment bank was crucial to make sure that we could run smoothly, more or less smoothly, the business. I have to say there was no impact on the day-to-day operations. I was distracted quite a bit, and a part of the executive team as well, but we managed to to keep track. Also, I think another important point is, besides the advisors, is also to have to create the right consensus in your between your shareholders, before the operation starts. Because when the details of the deal start to be laid down on paper, if you haven't cleared out in your mind what the path should look like, for next steps of the company, especially between the founding team, you probably risk to have some friction, which was not there in our case. We were quite aligned, but I think it was key for us to align on the vision and what we wanted to do before actually starting to invest so much energy, time, and money in the process.
One of the things that we see quite regularly is that the alignment that you may have as co-founders going into the process, once you get into the negotiations, once you start getting into the details of the offers, different structures, you realize that sometimes things kind of separate a tad. And it's quite common for having to sit down and review again and realign and really decide where those red lines are for what you really want. And I think a couple of you have mentioned that in the course. I know, Dr. Su, you mentioned that between you and your board and your co-founders, you arrived at some, a red line, that this is a number that we need to hit. Can you talk to us a little bit about that process?
So it's really interesting. I love hearing about the experience of all my co-panelists. I have to say that in the first exit, it was my first startup. I had no clue. I came out of AI R&D in government labs and did a startup. So I had absolutely no clue. I was green. I don't think I had the business smarts, even though I had a PhD in AI at the time, to do a negotiation that tough, right? And I relied a lot on my board. And then my board was great, but I have to say that the lesson I learned in the second company is to make sure your board is independent. They can have, options and things like that, but that, it's difficult when they're a shareholder for them to agree with you on what you should exit at. And if you think about it, the first company, we built it up right after the markets crashed in 2001. So by then, a lot of investors were scared and they wanted out. Right. And I said, no, 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 we just have to get the right number. The second one was interesting. They respected what I thought, because I wasn't going to exit again. And plus, because we had so many other companies that could have bought us. We had Quorum in the wings that was waiting to take us with bated breath to a whole bunch of potential buyers. I had to have a number. And so I was the most stubborn in the second one in terms of the red line. And even though I would have to say that maybe my I don't know if my co-founder, but he was very respectful. But the rest of the board and the board was great, actually. One of the board members said to me, these guys, they know hardware really well. They don't know software. So they're as hungry for you. So don't sell yourself short. I got that as a strong piece of advice from one of my directors, because he had exited a company to a huge wireless company. So you have to have these people surrounding you. I agree with you guys 100%. If they can't be your executives, they need to be on your board. Even if you don't listen to them sometimes, it's so important to have that number in your head and to negotiate towards it. Because then what happens with the people you're negotiating with is they'll try and figure out how to get you that number. And in both exits, one was supposedly an earnout and one was supposedly a payout. But I have to tell you, both of them had the golden handcuffs that we didn't dare do anything for 3 years. So I don't know what you want to call that, but they gave us, at least in the second one, the actual number that I had in my head. So I think I was the stubborn one.
And I guess Frenkel, in the case of Arkstone, how did you guys navigate that process? I understand you've got a couple of co-founders as well.
Yeah, it's very good points that our panelists have made on that. But I think we have to do like almost daily huddles to get on the same page. Typically, from one conversation to the next, our minds will go in different directions on what we want, and there's always there's always back and forth to the opposite party, so that changes the dynamics. But I think we had these like come down to earth huddles that we had to do, where we had to reorient ourselves on exactly what it is we want to get from the deal. And that really helped out, honestly, because, it's not without calls being frustrating and sometimes stretched out for hours, talking to my partners on what we want from it. But I think it's healthy dialogue in order to make the deals work, without destroying the deal, because there's so many different opinions, and we have 3 co-founders, you have 3 different opinions, sometimes 4 opinions with 3 people. So you have to really reorient yourself. Okay, what are we trying to achieve? Let's get back to the basics. What was the whole reason we went down this road in the first place? Why is this necessary for us to do this? And hopefully all those lined up, then you have yourself a deal. So that's really what we needed to do. It took time, patience, but it's a necessary part of the whole process.
Hmm. And I guess, Scott, for you, what kind of advice would you give to someone that's now saying, okay, maybe what's happening in the market, you had feedback from your clients, from your customers driving, and you're saying, okay, what advice would you give? We heard a little bit about preparation, et cetera, or things maybe you would do differently next time if you find yourself in that position. How would you approach someone that reaches out for advice?
So what I would say, and I've given this advice to a number of friends and people that I've come across that are kind of thinking about going down that road. And I always say, if you think you might be headed down that road, it's probably time to talk to somebody, in our case, Quorum, right? And having that expertise of people that live and breathe this stuff every day. Dr. Sue going through that many exits and so far, I can't imagine. This was a once in a lifetime probably event, for me, and really didn't have any experience going into it. So I think it's really important. The other thing is, I think, to really assess as a company. Everybody has strengths, everybody has weaknesses, and there's no embarrassment, but a really honest moment in the mirror of where are we strong, where are we lacking, what do we need to do to really round out the team, okay, going into it. And then the other thing that I would say is, we're a SaaS business. So in our world, as like with most businesses, extremely metrics focused, with very well published, here's where you need to be each corner of the business, doubling down in those investments or commitments to make, to know that you're going to need to get at that data. People are going to ask questions, even if you don't run your business with that data as diligently as you should. It's time to double down and really understand the very, very specifics of that business going into the process.
No, I think that's fantastic advice. In fact, when you start looking at, as you mentioned, SaaS businesses tend to be very metric driven. A lot of things that we see is that sometimes even though businesses can be managed and driven straight through their KPIs, uh, because you're not living and breathing the kind of M&A process, a lot of the metrics that the buyers are looking for as they evaluate the business are not the typical ones that you run your business around. So one of the things that we come across a lot is feedback from our clients, for founders saying, "I wish I knew this metric was important. I would have kept my eye on it 6 months ago to make sure that I could tweak it heading into the process." Uh, I guess Giacomo, I guess same question to you. What kind of advice would you give to someone who is now contemplating saying, maybe M&A is something for us?
So it's something that can be scary at first if you haven't gone through it, and sound like you're gonna, to me at least, before I embarked on this, it sounded like, I'm giving out my baby. I'm saying goodbye to the baby I've built for all these years. The truth is, it's a very it's a process that really sets you free as an entrepreneur and as a manager, and provides a fresh perspective. So don't be scared. Try, if you think that your business sometimes will need to go through an M&A to grow. When you think it's the right phase, just start preparing for it. Get the right advisors. You don't want to negotiate brutally with the people that are going to be your colleagues or your boss in a few months down the line. So get somebody in between, that can help you preserve the human relationship with the other party, with the buyer, and just do it. I mean, we're all very happy in the company after the deal. We've probably been lucky, but yeah, I mean, there's no disadvantage. Maybe it's
So
still honeymoon. I mean, it's just a few months down the line. It's less than 6 months, but so far so good.
that's wonderful to hear. And a couple of you have already mentioned the importance of having the right kind of advisors in the mix. And how would you go about, I guess, choosing your advisors? So, I mean, as Scott, as you mentioned, for most people, this is a once in a lifetime kind of event. You don't get to practice by doing it tons of times. And the team that you surround yourself with is really important. So I'd like to hear a little bit about what advice you would give to someone on how to choose that team of advisors. And I guess maybe start with Dr. Frenkel here and move along.
I think it's echoing what everybody in the panel's already noted. It's really working with teams of people who have a wealth of experience in this process, because it was new to me. I've never experienced this before. And it comes down to finding people who are experts who've done this so routinely. It's just a normal job for them. We found that with Quorum, of course, and we're lucky we found some good accounting and legal advice as well. But because this process has so many ups and downs and so many backs and forth, it's hard for somebody like myself to gauge what is considered normal and what's considered abnormal, or should I be worried about this request? Is this request normal? And Manuel, I think you remember my back and forth with you throughout this process. But I'd say without having, for example, you by our side, it would be very, very hard to make this deal happen, because I don't know. I don't know how to gauge the normalcy of this. If this is a normal request, is this how people normally negotiate? I had no idea. So it's really finding the teams with the right experience so that they can be that compass for you of what to expect, and being honest with you. Okay, this is not something you should entertain, and this is something you should entertain, and the deal's looking good. I would be unfortunate if you said no to a deal like this. You need somebody to really ground you with those kind of metrics. So that's to me, the most important advice. You have to find people who can work with you through the process, who are going to be honest, and who are going to help navigate this whole experience.
Excellent. And then Scott, how was your process in selecting an advisor? How did you arrive at your choices?
Well, a couple things. I mean, first and foremost, I could tell immediately. I was involved in a lot of quorum events, education events, in our sort of research process and trying to, figure out what it is that we wanted to do. I could tell right away that Quorum was really, really knowledgeable about particularly our business. And in our case, we weren't too small for them, which some advisors, just depending on the size that they really want to, focus on, we just weren't quite big enough. Okay. Quorum knew our space very, very well. In some of the process of early discussions with Quorum, what I particularly loved was that we weren't going to go dive into metric scorecards. They really wanted to focus on what's the story, how did this happen? The people, the side of it, the human side of it. And I felt like that was probably the strength of HIRECLICK, was that story and what it had grown into. And it was just a really good fit there. And then last, what I would say is I also felt that the reality is I don't know if we're going to be able to find the right fit for a buyer without an expert like Quorum. As it turned out, I don't think that there could have been a better fit anywhere on the planet than the company that we aligned with. We had the same ICP, same customer. We didn't overlap on any geography. They wanted a recruiting expertise. They didn't have it. We wanted the rest of the HR stack. We didn't have it. So I really appreciated that there was this pool of knowledge ecosystem all together in one, and couldn't have been happier with the way it turned out.
No, fantastic. And I guess, what's life like after the deal? So that's that's the other question that we get. And we often see that with entrepreneurs who've dedicated all this time and energy in building this. A couple of you have referred to it as their baby, and now suddenly you get into the deal, it's done, and there's the now what moment. Dr. Su, you've gone this through a couple of times now. What's your view on that? What's life after
You
the
that
deal look
one
like?
first. So in the first play, as I said, there was a very clear, and I had no experience. There was a very clear, you have to be with us for 3 years. And because we did it as an asset deal, and we had a wireless business still in the company, but we sold the compliance business to Entrust, I had a good excuse to get out and do something with that wireless business. Because remember, the whole markets had crashed, $90 billion market disappeared overnight in wireless, et cetera, et cetera. So in the first one, they had asked me, well, instead of a contractor, don't you want to become a vice president or CTO? And I said no. And it was interesting because my thinking was I would get out and run this other piece of the company. And that's now one of the pieces of advice I give in this book. You can do an asset sale, do an asset sale. Because if you're a serial entrepreneur, you can jump out and do it again. You'll have a structure. And so I think right after the deal, you're very happy, you're excited. The teams are all getting together, enjoying them, partying together, celebrating, getting new swag from the buyer, et cetera. And you're doing it. But what happens to entrepreneurs, because you want to create, and in my case, I'm an inventor, I'm a creator. I like to do this again. You get restless. And so in my book, I actually recommend, if you're an entrepreneur, product entrepreneur, you should try and negotiate your way out, as fast as you can. If you can do it in 3 months, fine, 6, 12 months, fine, but get out as fast as you can and start building something else. In the second one, it was much more obvious that I should get out as fast as I can. The first one, I lasted 2.5 years, which is kudos to me if you know my personality, which you do on the board now or on this panel. In the second one, I lasted, I think it was 11 months, and I was able to negotiate my way out because we had some amazing customers that were very loyal to us, like, the RCMP, the CVSA. The company had security clearance, the individuals had security clearance, et cetera. And the buyer was very interested in all of that, right? And so now again, we did an asset sale, and they tried as much as possible to take everything out of the company. And the word Amica, by the way, became a little bit of an issue because in both companies I had managed to keep the word Amica, but I don't have it anymore. I don't own it. So essentially, I would say, because a lot of acquisitions at the end of the day do not necessarily succeed in the favor of the entrepreneurs and the teams. they're good to do because you shouldn't do lifestyle companies when you have investors. When you have investors, you need to exit. You need to figure out what's your exit strategy. Everybody has said once you've done one exit, you need to do your prepare for your diligence. So get your documents in hand, make sure you know your numbers, understand how fast you get to revenue, all that sort of stuff, and know your projections, because you will need that all for diligence. And there's hundreds of documents. Our acquirer in the second case merged with another legal firm, and we went from negotiating with maybe 2 or 3 lawyers to negotiating with like 25. And so immediately that complicates your deal. So I would say that would be my answer. I don't know if that was a very good answer for what you expected, but
No,
build
it's
to
good because it's,
exit
I mean, it's a very clear perspective from a particular kind of a style of
a
entrepreneur
product company, right? We're
that
a
you're going
product
and moving.
company. We're
Yeah.
inventors. We build the future, if you will. And so that's what was very exciting to us. And initially, you're right. You're 100% right. It's your baby. You don't want to let it go. You don't want to let it go for a steal, yada, yada, yada. But once you do that once, and you exit, as I said, in an asset deal, you have a structure. So you build a second company. And then in the second one, you exit again, you build a third company. So that's really what worked out well for us. And Scott, I'm 100% with you. We'll see if I have the stamina for the third exit. We'll see. Right.
What about for you, Scott? What's life after the deal look like for you?
Well, first and foremost, both myself and my co-founder are happily employed by the company that acquired us. So 15 months after the exit, we were still working there. When you're looking for that buyer, and part of what I was mentioning before on a fit, the financial concern of the fit was, of course, very important. Okay, but just as important to us, a lot of our employees had worked with us for a really extended period of time, poured in just as much blood, sweat, and tears as we did, and it was really important that everybody came along. And I'm really, really happy to say everybody came along. Everybody's still now at the company that acquired us, and down that runway. On a personal side, really humbling experience after an exit event like that. Humbling in the way that, there's a real sense of what was a really long journey and just, accomplishment, but also we felt a lot of responsibility to make sure that, that our team saw this as a good event as well. So I would imagine, it's 15 months, as I mentioned, after, I would imagine it's going to look a little different 3 years after the event, 5 years after the event, and so forth. But right now, it honestly, it's a lot of the same in the way that's still very active in the business, very, very busy in the business, but with a lot less nights where you wake up and, wonder how to pay the electric bill. So it's a good all the way around. And as I've mentioned, it worked out fantastic. And we're really thrilled in the situation that we're in, even after a year past the event.
Oh, that's wonderful. And again, we talked about it earlier, but you mentioned it as well. This issue of fit and direction, especially when you're an organization that's looking for a partner, a buyer to help drive growth and scale. And I know that's Giacomo. That was one of the things that you'd mentioned as well. What's life like after the deal for you? How are you happy with the outcome of the process, and what does this look like now?
I'm very happy with the outcome of the process. I have to say it's pretty much the same, apart from the fact that it's much busier. Our deal is a two-step deal. So it was not a full 100% acquisition, but it was a majority stake acquisition, and the 100% acquisition will happen in 3 years' time. And in the meantime, all of the founders are still in the roles. So I'm very happy, and I'm even more motivated than before, because I know that, whatever we push in this phase is gonna be like a second exit, which has already been negotiated in 3 years' time. And the motivation also comes. I resonate. What Dr. Sue said before resonates a lot with me. As long as we can keep to be creative, and we have the independence to be creative in our day-to-day business, I think we're going to be really happy. And the buyer in this case has been very savvy, because they basically left us as a separate company. So they said, okay, you guys have your own path. We're going to help you along the way, but you go and grow, with our support, but you're independent. And I think that's a very important fact to acknowledge, the entrepreneurial and the creativity of the founding team to keep us
That's
engaged.
Yeah, and I think that's super important as one of the aspects in how you determine that fit and that alignment kind of envision. And I know, Dr. Frenkel, you alluded to it earlier, but I'll ask you the same question. What's life like now? How fired up is the team? What is it? Are you happy with the outcome and what life kind of is bringing your way?
Sure. I would echo what everybody else on the panel just mentioned. It's things have been really good, and in our case, especially in my particular interest, was what this will look like once we sign the deal. I was very focused on that because it's about working well in teams and having compatibility with the new teams you're going to be in. I very much feel that's important for the success of any company, because you can have great minds in a room, but if you don't get along, you achieve nothing, because you can't get those the juices to flow because of conflict of ideas. But I can say that it's been really well since we've partnered up. We still have full autonomy as previous co-founders of the company, and we have creative autonomy as well, which I think, as Dr. Su said, is so important, because to our core, we are inventors and we are innovators. And if we don't have that component, we'll lose interest. So we do have that component, and we have the resources now available to expand upon that. So I think there's more opportunity and more that awaits us. We're getting along great with the new team, and they're just as motivated, and they put some really interesting people with a wealth of knowledge in the team as well. So I'm happy to be paired with people who know more than me and who can help advance my vision. So it's been really good. It's still very early for us as well. We're just 2 or 3 months into this, but now we have, I think, a clear vision and future that awaits us.
That's wonderful. I'm very happy to hear that. And once again, I mean, I think this has been an excellent kind of discussion, because we managed to cover a little bit from many different industries, all of them kind of weaving the topic of companies that really are either fundamentally or rely on AI as part of how you do what you do. Everything from, similar, but in some cases kind of different types of motivations, different experiences through the process, and kind of leading to what are, for all of you, fantastic outcomes. So in several of these cases, obviously, we've managed from a quorum perspective to be a part of that journey. And it's wonderful to see you guys haven't been able to realize your goals in embarking on a process in the first place. So I did want to thank you all very much for your time today, for sharing your insights, a bit of your journey. As you know, a lot of the folks tuning into this webcast are where you were a few months ago, a year ago, starting to think about where do we go next. So I'm sure that everything you've shared is really going to help all of these other entrepreneurs as they navigate that decision for themselves. So thank you all again very much for your participation in today's panel, and let me pass it back to our team.